Corporate finance presentation. Warrants. Get ready, it's time to take our chance with corporate finance. Warrants are an option to buy a set number of shares of common stock at a specified price over a given time. So in other words, if we had a warrant, we would typically have the option to purchase some set number of common stock at some set price, that typically called the exercise price. Similar to an option, but the warrants typically have a longer time frame in which they can be exercised. They're often issued as a sweetener in a bond offering, so they can make the bond offering go over more easily typically. Firm may be able to issue debt with low-quality credit ratings in a high-interest rate environment with the help and use of warrants. They are usually detachable from the bond issue, so if they're issued with bond, they're typically detachable from it and possibly then able to trade separate from the bond itself. Note that they're not tied to anything directly. They're the option to be able to purchase some set shares of common stock, but they are not common stock themselves and don't have a direct claim to the equity section of basically the balance sheet in that format, although they are a claim to be able to purchase common stock at a set price. Therefore, they have their own market price, so they're going to be driven by their own market price, then that market price being closely tied to then the fluctuations in the market price of the actual stock itself. Warrants can be traded on the New York Stock Exchange or over the counter. Warrants very speculative in nature. They are very speculative in nature, the warrants. They are dependent on the market movement. So obviously the warrants are going to be dependent on the movement of the market, especially with relation to the stock price. The warrant will value change during time when the common stock is volatile. So if the common stock is bouncing around, then the value of the warrant will of course change with regards or in relation to the volatility in the market for this stock, the underlying stock. Bond investor may be willing to accept a lower interest rate when warrants are attached. So that's that sweetening type of deal. If it's in relation with the bonds, the bondholder might be willing to accept a lower interest rate, which of course would be beneficial for the issuer of the bond, because then they can get financing, they can get capital at the lower interest rate, and the person that receives the bond has that warrant, which could be beneficial because that gives them some look for the upside in case things go well, when exercising the warrant could then be a beneficial thing, or they can of course trade the warrant. The warrant has intrinsic value, a calculation for the warrant, which would be I equals M minus E times N. I is the intrinsic value equals the market value of the common stock minus the exercise price of the warrant times the number of shares each warrant entitles the holder to purchase. So the intrinsic value is kind of what you would expect it to be. It's going to be, once again, the market value of the common stock, what the common stock is trading for, minus the exercise price. That's how much the warrant you'd have to actually pay with the warrant. So in other words, if I had a warrant, then I can exercise it to buy some number of common stocks. It could be like one, for example, one warrant, one common stock. And the exercise price typically then being lower than the market price, that's the benefit of the warrant. And so that would be the intrinsic value clearly. And then times the number of shares each warrant entitles the holder to purchase. Now, oftentimes it's one more warrant may entitle you to purchase one share, and therefore that could be one oftentimes, but it could be something like two or something like that as well. And so that would be the formula for the intrinsic value. Then we have the speculative premium, which is the speculative premium equals the warrant price, what the warrant is actually selling for on the market, minus the intrinsic value. So again, the intrinsic value kind of represents the difference between the market value of the stock and what exercising the warrant would be able to exercise for. And you would think that you can exercise it below the market price. Therefore, the difference between the market price and what you should exercise it for is the intrinsic value times, of course, the number of shares that you can buy with it. And then you would think that the warrant would possibly sell for something over that intrinsic value, because it's a speculative type of thing, thinking that the stock could go up in the future. And if it goes up in the future, the warrants will then be of value in the future. So that's going to be the price then possibly being over than the intrinsic value. So the warrant leverage, a negative speculative premium, will generally indicate the warrant is underpriced. So if we have a speculative premium back over here where the warrant price is less than the intrinsic value, then you would think that the warrant would be underpriced at that point. If the stock price were below the exercise price, the intrinsic value of the warrant would be negative or zero. So in other words, if I go back to my formula and the exercise price happened to be below the market price, well, then you'd have a negative intrinsic value, or you'd probably cap that negativity at basically zero or a negative value for the intrinsic value. The speculative premium generally goes down as the value of the warrants get closer to the stock price. So warrants used for corporate financing, so the warrants could be used for creating new common stock. Warrants may not be as desirable as convertible securities. So in other words, if you wanted to issue more common stock, basically get more common stock on the market at some point in the future and have some flexibility to do so, you could obviously issue the common stock directly, or you might use some kind of convertible security. You might use the warrants, which then can be converted to common stock sometime in the future, or you might use something like convertible bonds that we talked about in a prior presentation that you can convert into the future. Between the bonds and the warrants, it might be more favorable to use the bonds in that situation if you're trying to get, financing, equity financing out there through the issuance of common stock over time, because the bonds have a little bit more of the ability to exercise them or force the exercising of them if they have a call option, which kind of gives you the ability to force the call option to take place, which might force people then to exercise the bond option and then convert them to the common stock if you so choose. So companies with warrants do not have the option of forcing the conversion of debt into common stock. They may be able to provide incentive using the step up in the exercise price. Note that there is dilution, of course, here when we're thinking about the warrants, because if they issue the warrants may lead to added common stock in the future. So if you issue warrants, then possibly that could lead to more common stock that is going to be out there in the future. So you got this diluted earnings per share that might be needed to be calculated. The different measures of earnings per share may be needed, include the basic earnings per share, which would simply be the earnings of the company divided by how many shares are outstanding. And then you may need the diluted earnings per share, which is us to estimate how many shares could be out there if all the option kind of things, like including the warrants, were exercised. How many shares then would be out there, and then calculate the earnings per shares based on the maximum number of shares that could be out there given all the securities that are currently on the market if they were then to be exercised.